In 2018, the richest man on the planet paid less in taxes than a McDonald's cashier, not as a percentage of income, in absolute dollars. While his wealth exploded by tens of billions, his tax bill was zero. This wasn't fraud. This wasn't evasion. This was strategy. A perfectly legal system so powerful that America's wealthiest individuals use it to avoid paying taxes on hundreds of billions in wealth growth every single year. The math is staggering. Between 2014 and 2018, the 25 richest Americans saw their combined wealth increase by $401 billion. Their total federal income tax payments during that same period? Just $13.6 billion. That's an effective tax rate of 3.4%. Meanwhile, the median American household pays between 10 and 12%. You're literally paying 3 times the rate of people who are thousands of times richer than you. But here's what should make you furious. This isn't happening by accident. This isn't some oversight in the tax code that Congress forgot to fix. This is a deliberately engineered system, lobbied for and protected by the same people who benefit from it. A system so effective that it has a name among financial advisors and estate planners. They call it buy, borrow, die. And once you understand how it works, you'll see why billionaires can live like emperors while paying virtually nothing to the government that protects their wealth. The strategy has 3 simple steps. Each one is legal. Together, they create a tax avoidance machine that would make medieval kings jealous. Because what we're really talking about here isn't just tax avoidance, it's the systematic transfer of the tax burden from the people who have all the money to the people who have almost none. And the gap is so extreme, the numbers so outrageous, that if you saw the real data, it would fundamentally change how you view the American economy. Let me show you exactly how this works, who designed it, and why you'll never be able to use it even though you're paying taxes to subsidize the very system that protects it. Step 1 is deceptively simple. Buy assets that go up in value over time. Stocks, real estate, companies, art collections, anything that appreciates. This isn't revolutionary advice. Every financial planner tells you to invest in appreciating assets. The difference is scale and strategy. When you buy stocks, you eventually sell them to fund retirement, buy a house, pay for your kids' college. When billionaires buy stocks, they hold them forever. Jeff Bezos owns nearly 1 billion shares of Amazon. Elon Musk controls hundreds of millions of Tesla shares. These holdings grow in value every year, sometimes by billions of dollars annually. But here's the crucial detail that changes everything. In America's tax system, you only pay taxes on investment gains when you sell. If you buy a stock at $100 and it rises to $200, you've made $100 in profit. But the IRS doesn't care about that profit until you actually sell the stock and realize the gain. This creates a massive loophole for anyone wealthy enough to exploit it. While your Amazon stock sits in your brokerage account growing from $100 to $1,000 to $10,000 per share, you owe exactly $0 in taxes. The gains are unrealized, which means they're invisible to the tax system. You could be worth $100 billion on paper, and as long as you don't sell, your taxable income could be zero. Normal people eventually have to sell because they need money to live. Billionaires have found a way around this problem, which brings us to step 2 of the strategy. Instead of selling assets and triggering massive tax bills, they borrow money using their stocks as collateral. This is where the system becomes truly brilliant from their perspective and truly infuriating from yours. Here's how securities-backed lending works. You walk into Goldman Sachs or Morgan Stanley with $100 billion worth of stock certificates. You tell them you want to borrow $500 million. The bank looks at your massive pile of collateral and says, absolutely. They'll lend you that money at incredibly low interest rates, sometimes as low as 2% annually. You walk out with $500 million in cash, and here's the beautiful part for the billionaire. Borrowed money isn't considered income by the IRS. Think about the implications of this for a moment. If you earn $500 million in salary, you pay 37% federal income tax plus state taxes. That's roughly $185 million in federal taxes alone. If you borrow $500 million using your stock portfolio as collateral, you pay 0 income taxes because technically you didn't earn anything. You just took out a loan. The interest rate on these loans is typically far below the growth rate of the underlying assets. If your stock portfolio grows at 15% per year and your loan costs 2% per year, you're making a 13% net return while living entirely off borrowed money. You get richer every year without ever paying income taxes on the wealth growth that funds your lifestyle. This system only works if you have massive assets to begin with. Banks don't offer 2% loans to people with $100,000 portfolios. You need tens of millions at minimum to access these preferential lending terms. The more wealth you have, the better rates you get. It's a system designed to benefit people who need it least while excluding everyone else entirely. But what happens when the billionaire dies? Surely someone has to pay the taxes eventually, right? This brings us to step 3, which is where the strategy becomes truly extraordinary in its audacity. When a billionaire dies, something magical happens in the American tax code. It's called the stepped-up basis, and it's arguably the most generous gift the government has ever given to wealthy families. Here's how this works in practice, and why it represents the final piece of a system so perfectly designed to protect dynastic wealth that it almost seems too outrageous to be real. Let's say you bought Amazon stock in 1997 for $1 per share. Today, that same stock trades for around $150 per share. If you sold those shares while alive, you'd owe capital gains taxes on the $149 per share profit. At a 20% capital gains rate, that's roughly $30 per share in taxes. Multiply that across millions of shares, and you're looking at billions in tax liability. But if you never sell and instead die while holding those shares, the tax code performs an accounting miracle. Your heirs inherit the stock with what's called a stepped-up basis. Instead of inheriting your original purchase price of $1 per share, they inherit the stock at its current market value of $150 per share. The $149 in gains that occurred during your lifetime simply vanishes from a tax perspective. The IRS pretends those gains never existed. If your heirs immediately sell the inherited stock for $150 per share, they owe zero capital gains taxes because their cost basis is $150. There's no gain to tax. Decades of wealth appreciation, potentially billions of dollars in profits, completely erased from the government's books. Now, what about all those loans the billionaire took out during their lifetime? The hundreds of millions or billions borrowed against the stock portfolio? The heirs have two options, both of which maintain the tax advantages. They can sell a small portion of the inherited stock to pay off the loans. And thanks to the stepped-up basis, that sale triggers no capital gains taxes. Or they can simply take out new loans themselves and continue the cycle indefinitely. This is how generational wealth is preserved and expanded while remaining almost entirely outside the tax system. The first generation builds the fortune, the second generation inherits it tax-free, and the third generation continues borrowing against it while it grows. Each generation can live lavishly off borrowed money, and when they die, the slate gets wiped clean again. The numbers behind this system are staggering. According to economists who have studied this phenomenon, the stepped-up basis alone costs the federal government between $40 and $60 billion annually in lost tax revenue. Over a decade, that's $600 billion that could fund infrastructure projects, healthcare programs, or education initiatives. Instead, it's protecting the wealth of America's richest families. But this didn't happen by accident. The stepped-up basis wasn't some oversight that slipped into the tax code unnoticed. It was deliberately created in 1921, less than a decade after the federal income tax was established. The stated reason was to avoid double taxation, but that logic falls apart under scrutiny. If gains were never taxed in the first place, erasing them at death isn't avoiding double taxation. It's avoiding all taxation. Buy, borrow, die. 3 words that represent the greatest tax avoidance strategy in human history. A system so perfectly engineered that billionaires can live like kings while paying less in taxes than their secretaries. While you're working paycheck to paycheck and watching 20 to 30% of your income disappear to taxes, the richest people in America have built a fortress around their wealth that the IRS cannot penetrate. And the most infuriating part, you're subsidizing the very system that protects them while being locked out of using it yourself.